So in this video, I'm going to give you the secret you need to navigate the 80-year long-term debt cycle. This is easy to understand once you learn to spot the repeating patterns that occur in every one of these cycles, and most importantly, how you should be positioning yourself to profit from this once-in-a-lifetime event. Once you understand this secret, it's going to make it much easier for you to navigate the unwinding of the long-term debt cycle that often ends in ruin for the majority of people. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you have learned is wrong. And of course, if you're watching mainstream media today, all the information you are getting is wrong, like President Joe Biden telling you that unlimited money printing has nothing to do with inflation. Yeah, right. Well, if the information you're getting from them is wrong, how do you navigate it correctly? Well, you need to learn from the experts, which is why I'm bringing 15 of the top experts in the world in each of their disciplines to share with you two secrets. One, what do they think is going to happen over the next couple of years? And two, most importantly, what you should be doing to protect yourself to get on the other side of this. All right, there's massive hope and prosperity on the other side as long as we can get through the problems over the next couple of years that we have to deal with. Come and check it out. There's a link down below. We have Harry Dent, the father of cycles and demographics, Danielle DiMartino Booth, a true Fed insider. We have Lawrence Lepard. We have George Gammon. We have so many other good speakers coming. Of course, I'll be there as well. There's a link down below. Check it out. It's an event you do not want to miss. You want to be there in person to meet the speakers, ask them questions, and meet a community of like-minded people. There's a link down below, marketdisruptorslive.com. All right, now getting right into it, back to the long-term debt cycle. The current global fiat monetary system and regime the world's operating on today is simply unsustainable in its current form. If you've been watching my videos regularly, then you know that an economic reset is on its way in some capacity. That's going to put an end to this era of fake counterfeit fiat currency as money. Now, throughout history, most people are blissfully unaware of an economic reset when it's occurring and subsequently lose everything during the volatile time. So, how should you navigate it? Well, in every hyperinflation or economic reset, there's a period of gradually, then suddenly. You might have heard the quote from Vladimir Lenin in which he read, "There are decades where nothing happens, and there are weeks when decades happen." And that's what's happening right now. Now, most of you would be aware that we're living in extraordinary, unique times as we near the conclusion of a financial, political, and technological revolution cycle. Now, as you can see from the chart I have up on the screen, for the first time in history, these cycles appear to be converging and look set to all unwind simultaneously here in the 2020s, in this decade. We covered the convergence of these three cycles and the world-altering ramifications I believe they'll have in depth in a three-part video series I did last year. Editor can link the video up here if you want to go back and watch it. Now, the cycle I want to focus on specifically today is the 80-year financial revolution cycle, which occurs at the conclusion of the long-term debt cycle. Now, interestingly, this appears to be unfolding alongside the monetization of a new form of money, which we'll circle back to at the end of this video. Now, we've talked at length on this channel about the unsustainability of the current monetary system, and it's all because of debt, which, as you can see from the chart I have up on the screen, has continued to increase with each asset bubble that's been blown up over the prior 20 years. Hirschman Capital released a fascinating report showing that since the year 1800, 51 out of 52 countries that have reached sovereign debt levels greater than 130% of GDP ended up defaulting on their debt within 15 years. Now, default came through either a devaluation, inflation, restructuring, outright nominal default, or an implicit default, like was seen back in 1971 during the Nixon shock and the U.S. refusing to make good on their obligation to allow countries to redeem the U.S. dollar for the gold it was supposed to be backed by. So in simple terms, central banks normally choose to default through inflation and currency devaluation. They do this through irresponsible monetary policies such as money printing or increasing the money supply, which devalues the currency so that they can pay back their massive debts with the devalued dollars. With debt levels today above this 130% level and higher than at the conclusion of the prior long-term debt cycle, central banks are stuck between a rock and a hard place. Now, we talked at length about this rock and a hard place that central bankers find themselves in this recent video. And today, I want to analyze how you can navigate and manage your finances through this radically volatile event. Now, we've seen the conclusion of these economic cycles unwind many times before, and there are always some similar societal behaviors that tend to be seen when we're nearing the end that serves as warning signs. Now, this quote from Lenin describes current day events perfectly. I'll quote him. "The best way to destroy the capitalist system was to debauch the currency. By a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. By this method, not only confiscate, but they confiscate arbitrarily. And while the process impoverishes many, it actually enriches some." The sight of this arbitrary rearrangement of riches strikes not only at security, but also at the confidence and equity of the existing distribution of wealth. And then he finishes it off with the most important part here, which is he says, as quote, "As the inflation proceeds and the real value of the currency fluctuates wildly from month to month, all permanent relations between debtors and creditors, which form the ultimate foundation of capitalism, become so utterly disordered as to be almost meaningless," and here's the best part, "and the process of wealth getting degenerates into a gamble and a lottery." As inflation is soaring to its highest levels in 40 years, real wages simply aren't keeping up with the rising cost of living. As you can see from the chart on the screen, real median wages have stayed flat and are not keeping up with the GDP numbers or the economy. This is naturally leading people to leave their productive jobs in favor of seeking other alternatives of accumulating wealth. As you can see from the chart I have on the screen, in 2021 ended with the quit rate, or the amount of people quitting their jobs, at an all-time high. Now, if everyone is quitting the workforce, where are they going? I mean, look around you. We have a record number of job quits as the everyday person leaves their productive jobs in favor of trading options on Robinhood, cryptocurrencies, and NFTs that are similar to JPEGs of a rock, and they're selling for millions of dollars. The graph I have up shows you the point more clearly. By showing the exorbitant premiums that retail traders are paying just to engage in options trading, the premiums on call options that are being paid on positions smaller than 10 contracts or less has increased by over 800% when compared to 2019. And on this chart, we can see it measures the ratio between call and puts, which paints a similar story. This ratio surged in 2020 and 2021 levels 500 to 600 times higher than any time over the previous 20 years. The point here is that options are for gambling. You're only betting on the price direction of a stock versus buying stocks, which is owning a share of the company or investing into it. This chart could not back up the point I'm referring to any better. The longer we've strayed from a hard money system and the closer we've traveled towards hyperinflation, the more people become fixated on speculating as opposed to producing goods and services. Now, the volume of futures trading has increased by over 1,300% since 1971. Speculation and gambling, like behavior, becomes common during hyperinflationary events. There's countless stories that we can look at from Venezuela, Argentina, and Zimbabwe that highlight as the currency is destroyed by the economy, it reverts back to resemble a barter or gamble society. In every hyperinflation, there's a period of gradually and then suddenly. However, every time we're on the precipice of the suddenly moment, policymakers will never accept the inevitable hyperinflation. Now, wealth destruction, speculation, and a regressed economy are some of the societal consequences as the currency and capitalism start to break down. But how do you navigate it so you can build, grow, and protect your wealth during these times of high volatility? Well, let's take a look at a couple of previous examples of hyperinflation to gain insights into how to optimally trade such a volatile event. Now, first, for those unfamiliar, take a look at what hyperinflation does to your money's purchasing power. In Germany, in 1918, a loaf of bread was only 1 German mark. And in 5 years, it was 200 billion German marks. Now, marks were worth so little that people were actually burning them in their fireplaces because it was cheaper than burning wood. Most people are familiar with the chart of the hyperinflation of the German mark against gold in the early 1920s. Now, looking at this chart, it looks so simple, right? If you would have just traded your fake fiat paper marks for gold in 1918 and held them until 1923, you would have made a fortune, right? Yes, but when taking a more granular look at the chart, below we can see that just how volatile the price of gold was during the Weimar hyperinflation. The red line that measures the monthly percentage swings in the gold price shows that on 8 separate occasions, there was a 50% drawdown in the price of gold between the years between 1917 and 1923. Now, this is an important point to understand. Hypothetically, imagine you were one of the very few people who understood the economics of the German debt crisis and understood that the currency would hyperinflate in the early 1920s. You even made the correct decision to buy gold and dump the German marks. Now suppose you also decided you were going to trade this once-in-a-lifetime event by going leveraged long gold. Even with a very small and responsible 2 times leveraged long gold position, you would have gotten liquidated on 8 separate occasions by each of those 50% corrections. Now, you were directionally correct. You did 99.99% of the hard work, but to quote my good friend Greg Foss, you were trying to be too smart by a half. That's what he says. Now, it's also important to note that through each of these large corrections in gold, the economy was going through a deflationary shock. Now, during these times, economists and financial officials always claimed prices were about to return to normal. In every one of those 6 deflationary crashes shown above, the everyday populace believed this was the return to normal, quote unquote normal. This was an important aspect of financial resets and hyperinflations. Once faith is lost in the currency, it unwinds rapidly. Now, with each time that the officials were proven wrong, as prices in fact didn't normalize and instead continued exploding higher after each dip, more and more people lost faith in the currency with each one of those successive deflationary shocks. Now, this quote originated during a speech given by the German finance chancellor in the summer of 1922. He said, quote, "The chancellor would accept no connection between printing money and its depreciation. Indeed, it remained largely unrecognized in cabinet, bank, parliament, or press." End quote. It's from the book When Money Dies. Now, policymakers were desperately trying to dispel the fears of rising inflation, which was blamed on any reason except the expansion of the monetary supply. Fast forwarding to today, doesn't that seem eerily similar? Policymakers today similarly will refuse to acknowledge that monetary supply growth is causing inflation. First it was supply chains, then it was only transitory, then it wasn't transitory. With the new excuse for higher inflation being the Russian war, are we about to witness the suddenly moment when everyone finally realizes inflation isn't abating and in fact it's a deliberate policy action? For those of you thinking, yeah, but that was 100 years ago, Mark. Times have changed, right? Well, let's look at a more recent example in Venezuela. Their stock market was the best performing market during their recent hyperinflationary event. Some people would look at that chart and proclaim stocks are a great store of value during inflation. Everything in an economy increases in price when denominated in the devaluing currency. The true value of one's wealth should come from the amount of goods and services you can buy with your money. Now, this is another reminder of the importance of not denominating in the local currency. For a more detailed explanation of this phenomenon, I recently did an entire video breaking down this great thread from my good buddy Preston Pish, where he demonstrated the importance of denominating your asset measuring in the expanding monetary supply. You can check it out here. So that may be all well and good, but how do you navigate it profitably? Well, we demonstrated that using leverage is a surefire way to get liquidated, even using a low 2 times leverage that doesn't protect you from the wild swings in prices as the economic system nears its inevitable end. Now, those who protected themselves with hard assets survived the hyperinflations and currency resets mentioned above. In an earlier video, we analyzed how Hugo Stinnes became the richest man in Germany throughout the 1920s German hyperinflationary event. Now, Hugo borrowed money in the failing currency to buy income-producing businesses and hard assets like real estate and gold. This is an important lesson to learn that could help you weather the coming fiat tsunami. Buy hard assets, but don't use leverage, or use it at least very responsibly. The volatility will be insane, but those who can surf the waves will come out at the end of the period on the right side of what could be the greatest wealth transfer in human history. You need to be able to practice patience and lower your time frame preference, because instant gratification isn't something you should seek when investing your money. Zoom out, don't lose sight of the bigger picture, stick to the trend, and you're going to be okay. Hopefully that helps, but I'd love to know what you think. You can leave me a comment down below to let me know what you think about zooming out and riding the trend out without over leveraging yourself. And of course, as always, give me a thumbs up on this video if you like it. If you don't like the video, that's okay. You can give me a thumbs down, but at least leave me a comment and let me know. And like I said at the beginning, don't miss Market Disruptors Live 2022. There's a link down below. 15 of the best speakers in the world: Danielle DiMartino Booth, Harry Dent, we got Luke Grumman, don't miss Luke Grumman, George Gammon, myself, and so many others. There's a link down below with all the information, and that's what I got for you today, all right? To your success, I'm out.